In this video, we'll be going over Chapter 12, Section 2 notes talking about business cycles and what factors affect the phases of a business cycle. So let's find out what a business cycle is first. A business cycle is a period of macro expansion followed by macroeconomic contraction. Now we can find this on a micro level as well. It's just not on macro level where we find business cycles. It's on both. So let's talk about the different parts of a business cycle. Well, in a business cycle we have expansion, and at the top of that expansion is known as a peak. Whenever we see economic growth, unemployment's going down, GDP has increased. When there's been steady growth, we always see expansion that takes place in a business cycle. Now, at the very top of a business cycle, let's say we reach full employment, we've reached our full potential at that moment in the economy, we hit something which is called a peak. And at the peak, that's where we begin, where GDP stops rising and it begins to drop down. That dropping down or lowering is known as a contraction. It's a period of where economic decline happens by falling real GDP. So we have expansion, the economy is doing great. Then what we find is we hit peak, and then at the very top of the peak we begin to contract. Unemployment begins to increase. We see inflation taking off. A bunch of other factors. Maybe we're heading towards a recession. The economy is tanked. For all these reasons, contraction can be taking place. Once we hit the lowest point in a business cycle, it is known as trough. And trough is the bottom of the very bottom of a business cycle. And that lets us know that GDP has stopped falling, and now it begins to curl back up again. So if we were to draw out, what would that look like? This is already a slide we've done. A business cycle would look like. We will demonstrate this in another slide, but that is the business cycles that we have. All right, types of contractions. So we hit that peak. Now we begin to see GDP slow down, unemployment's begin to rise, the economy is not doing as well. We have a period of time that is known as a recession. And a recession can usually be 6 months to about 18 months, where there's just kind of stagnant, not a lot of growth taking place. If it continues to follow and we have more of that taking place, what we have once we pass that period is known as a depression. And that's where the economy is doing terrible. As we've seen in our history, in our past, we have experienced a depression. You have lived through a recession where it began kind of 2005, 2008 era with the housing bubble crisis. But you and myself have never experienced a depression and what that is, and hopefully we never will. But it's just a stagnant, more longevity of a recession. And then we have something called stagflation. And then this is where we see a decline in real GDP with a rise in the price level. We looked at previously in Section 1 where we discussed about real GDP versus nominal GDP. If you remember, real GDP is taking a standard year and doing a comparison with years after that to see if we're actually growing in GDP, or is it just a matter of inflation, that rise in that price level that's allowing the prices to increase, but no growth is taking place. All right, so what actually keeps a business cycle going? How do we go from expansion to peak, recession, or all the way down to contraction to trough? How does that work all together? Well, usually in a business cycle, there's two things that need to take place. And here's the 4 factors. And if there's at least 2 factors when it comes to that happens at the same time, this is where we see a business cycle begins to move. So a business investment. This is where we talked about yesterday about the shift of macro, aggregate supply, aggregate demand, business investment. If the economy is doing well, what's going to take place is businesses are going to continue to expand, which means they'll hire more employees, which means they'll increase their stock value, which means they're going to have more bonds because they want to grow their corporations, and we're going to see expansion taking place. But when we see the economy begin to peak off and go to a contraction, that's where business investment slows down. Remember that whole idea of aggregate demand? If there's fear of recession, well, then people are not going to spend as much. We talked about if you have a job and your boss says you're going to lose your job in the next 2 weeks, what's going to happen to your spending habits? Same thing with business investments. If there's fear of recession, or if there are certain products that are not selling that are in that country, you could have business investments going the other direction. So that could be one factor. Interest rates and credit is another factor. When interest rates are low, people are more apt to go out and invest. And here's the reason behind that. If I can get a business loan at 4%, that's a very good deal. Someone would go out and do that. They're more apt to do that because the interest rate is so low. But if, let's say the interest rate increases to 15%, well, then that's going to slow down investing because interest rates are so high that people don't want to take the risk, or their expansion would not be able to keep up with the interest that would be building. So that interest rate, when it goes up or down, it does have an impact on the economy and consumers and businesses, because if the interest rate is high, people are less likely to go out and get loans because the rate is so high. When the housing bubble took place, a lot of people lost their homes, and because so many people wrecked their credit, no one was able to afford a home. So what the government did, the Federal Reserve did, is they dropped the rates for mortgages, and so it made it more affordable, more attractive to people to buy houses again. And so for first-time home buyers, it was a great deal because interest rates are so low, there was less risk there because of the interest rate, and that really helped accelerate the housing market to get back on its feet. Consumer expectations, kind of what they think the economy is doing. Again, this kind of ties to business investment interest rates. If consumers' expectations is that the economy is strong, they're going to go out and buy more things. But if they fear that the economy is weak, well, they're going to be buying less because it's the whole idea of not making sure you have enough funds, everything that you need. So the faith in the economy has a factor in that. There's actually a statistic that talks about that. I can't remember the exact name for it, but it talks about faith in the economy, people's perspective on the dollar and how the economy is doing. And that actually is a big factor in all this when it comes to spending habits. And then sometimes other things that can move a business cycle is an external shock. And external shocks, those are unpredictable. When we had the hurricanes take place down in Texas and down in Florida, when there's terrorist attacks, that has an external shock. When 9/11 happened in New York City, that was an external shock. It really took the economy and shook it hard and really bumped the business cycle in one way or another. Again, external shocks are very difficult to know when they're coming because they're spontaneous, no one knows about them, and that's where things change dramatically. So you need at least two of these factors in order for the business cycle to move. All right, so there's this company that is out there called the Conference Board, and the Conference Board, their job is to look at leading economic indicators to provide reports and give to economists and policymakers so they can give their forecast of what they think is going to take place in the market. One of those leading indicators that they're looking at is stock market. How is the stock market doing? Stock market's doing very well right now in the U.S. as of 2017. But if it begins to slow down, this Conference Board organization watches this indicator in the stock market to see which way it's going. Interest rates are another big one because they know interest rates are low, more investments as far as buying and expansion in business. If interest rates are higher, it's going to slow down things. So interest rates is another good one. The job markets is another leading indicator. So they look at these 10 indicators, be able to put a report together and say, this is what we think what's going to take place. All right, now let's look at business cycle forecasting from the past in the U.S. Um, Obviously, the biggest business cycle we've ever really seen happened in 1929 when the stock market crashed. And what we saw here, if you look at this chart in the bottom right-hand screen, is these are the years and the months and everything leading up to the stock market crash. So as you can see, I mean, we had massive expansion taking off here, and then it peaked off, and then as soon as 1929, that fall came around, what we saw was a major crash that took place. We actually had some economists saying about this time that it's going to double. We're going to see massive growth even past this. So people had faith in the economy, the economists, the experts that were saying things were going to continue. Well, they're all incorrect, and as a result, October of 1929, we had the stock market crash that took place. 1933, a few years later, 1 of every 4 was unemployed. That's 25% unemployment rate, which is absolutely massive. And that's not taking into effect those who are discouraged workers, those who began to not look for work anymore. FDR, after being elected, he kind of introduced a type of economics called Keynesian economics. And the idea is that we're going to spend our way out of this problem. He created a program called the New Deal. He created 2 administrations, one called Works Progress Administration, another one called Civilian Conservation Corps. If you go up to Gooseberry Falls in northern Minnesota, they have a statue up there, and that's the Civilian Conservation Corps. That was part of the New Deal, in a sense, it was making up jobs just to put people to work so they could pay them. What really got us out of the Great Depression was the World War II, was the introduction of us joining the World War II effort. Because all of a sudden now we have a massive demand for military, physical, human capital. We're actually down on, we're run out of workers, so the women workforce really joined during this time as well. So this expansion, getting a chance to read a little more into this, it was unbelievable how much people are investing. In our game that we're playing with the stock market, we talk about borrowing on the margin. And that means where you could borrow money to invest it, which you should never ever do. But that's what was taking place during that crash as well. Other things that took place, 1970s, we saw the U.S. had an embargo put against them. And what that meant is that OPEC, who was in charge of the majority of the world's oil at that time, we were providing aid to Israel, and some of those OPEC members were against Israel. So retaliation against the U.S. for what we did to help out Israel, they cut us off completely of our oil. And as a result of that, we saw skyrockets of gas prices. From my understanding, some prices quadrupled. I mean, it would be something like if it's $2.19 this morning, you wake up to find it's $8.76 the next day. I mean, it had a massive impact on it. If you've ever seen that Disney movie, Miracle, there's a scene there where the doctor and the assistant coach is sitting in line to get gas at the gas station. That was in part of OPEC's embargo on the U.S. There wasn't enough gasoline because we couldn't produce enough, but also the prices are outrageously expensive. 1980s, we experienced high interest rates, which was a result of a lot of spending that was going on. 1990s, we saw great expansion again in the business cycle. This is where the internet, websites, all that was really beginning to take off. We had something called the dot-com boom. And what that means is that anyone who is investing in technology, anything with a dot-com behind it, people thought was a great idea. And so we had all these different companies, online companies start up. People were just throwing money at these things because they thought they were a sure deal. And we actually went into a little bit of a recession there by the end of the 1990s. There was a company called Pets.com. if you ever got a chance to watch some of their commercials. It's a sock dog puppet that's explaining what Pets.com was. What Pets.com actually was nothing more than buying supplies for your pets online, and they would be delivered to your house. Well, come to find out, the prices were higher on Pets.com, and then people couldn't wait for their pets to get their food or whatever they needed, so they just go to the grocery store, or it's more convenient just to go to the grocery store to pick up food for their pets. Other forecasting that we see here, we went into a little recession, like I mentioned, in March of 2001 after the dot-com boom kind of exploded, that bubble burst, and then 9/11 happened. I mean, it completely destroyed hotel, airline, tourism industry across the world, really, because everyone was so fearful about traveling. As a result, small growth was beginning to bump us down into recession, so the federal government got involved, the Federal Reserve, and they began to lower interest rates, trying to make the economy bounce back. We did actually see a bounce back in 2003, where the economy did begin to grow again, and in 2006 we were hit with high gas prices. Gas prices in Minnesota at this time were all the way up to $3.99. I don't know if it actually hit over $4, but in more expensive states like California, they hit well over $4 a gallon. Luckily enough, we've been around the $2.40, $2.49 range as of 2007, but it could go either way. 2007, we actually saw a housing bubble burst that took place, and we've talked about that before. People were getting loans when they had no right to get a loan due to bad credit, having no credit history, giving it to people that were not known for paying their bills on time or at all. So as a result of that, house prices were way inflated. Their values of the house were way more than what they're actually worth, and things fell apart. When those things began to fall apart, we saw the banking industry to follow right behind it, because how were those mortgages being funded? Or they're being funded through the bank. And as a result of that, the banks had so many loans out there, more than what they should have had, and we saw a lot of the banking industry began to fall apart as well. So this is the end of Chapter 12, Section 2, dealing with business cycles. And we just went through the different cycles today, explained the different types of the parts of the business cycle as well. And this is the end of Section 2.